Good morning. Good morning. I'm surprised I didn't get the obligatory Jeb Bush joke. That's kind of a standing thing as of late. Just to be on the record, I am not related to Jeb Bush, but I am accepting donations. And you can see the lady in the back if you're interested in doing that. How many of you real quickly have seen Andy or me present before? Okay, so a fair number of you. For those of you who haven't seen us before, what our goal is to try to translate all that noise you hear in Washington around tax and policy and politics and translate that down into a conversation that you can have with your clients. How can you use those current happenings in Washington, D.C. to engage your clients in a little bit different way? So it's in that light that I want to just kind of share with you our agenda for today. I want to start by talking about the midterm elections. And I know what you're saying. You say, but Jeff, I already know what happened in the midterm elections, but I'm going to talk about it in terms of what happened in the midterm elections and the relevance of that for the agenda of the 114th Congress. But we'll spend the majority of our time today talking about the Affordable Care Act and tax reform and where we stand right now on that. And anytime I talk about the election, I always like to start with the House of Representatives. Now, if you followed Andy and I last year, or back in 2012, we told you don't be surprised when the Republicans have a fantastic midterm election. And the reason why is because of the 2012 elections. You see, you and I did something rather unique back in 2012. You and I gave single-party control to the majority of states, meaning at the state level, their House and Senate were either all Republican or all Democrat. And 2012 was a very important year. That's the year they got to redraw those House district maps. And because there weren't a lot of checks and balances across the two parties, well, they got a little creative in how they redrew those maps. And that creative redrawing process is called gerrymandering. And I've given you an example here of the 6 most highly gerrymandered House districts from around our country. Now, the real takeaway from this midterm election, though, is that the Republicans control the majority of states after 2012. That's why they have this built-in numerical advantage all the way through 2022. The next opportunity we have to redraw those maps. Now, you're really hard-pressed to even build a credible argument as to how the Republicans may lose control of the House before 2022 because of that built-in numerical advantage. But you know those Republicans like I do, right? They'll do their level best to try to lose control of the House. I'm just telling you mathematically, they're a little bit challenged in getting that done. But the reality is this election was always going to be much more about the Senate rather than the House of Representatives. We know going into that midterm election, the Democrats controlled 55 seats, and we saw almost a complete reversal of that where Republicans walked away with 54 seats. Now, we took the labor on to actually go down into each of those races and kind of understand those internal dynamics. And when we did that, we found one very clear platform for the Republicans. A more moderate Republican platform actually carried the day in those midterm elections. Now, why we care about that as analysts is a statewide Senate election is a much better proxy for a national presidential platform. That's why, in our opinion, you're seeing the more moderate Republicans get the early traction in this race towards 2016. But what's also true in this midterm election, the Republicans walk away with a governing majority, but they failed to walk away with what we call a legislative majority, meaning they failed to walk away with the 67 votes necessary in the Senate to override a presidential veto. President Obama still has tremendous power in this current Republican Congress environment. He has the power of that veto pen. As a matter of fact, the Republicans even failed to walk away with a consistent path to getting the 60 votes in order to override the Senate's own filibuster rules. And I know what you're saying. You're saying, but I remember distinctly last year Harry Reid busted the filibuster. Oh, he absolutely did. He busted the filibuster as it relates to presidential appointees and federal judges, not for Supreme Court judges or legislation. Both those issues still need to meet that 60-vote threshold. So it's obvious, ladies and gentlemen, why Mitch McConnell then is being much more open to the Democrats, allowing them floor time to debate bills moving through the Senate, even allowing them to add amendments to those bills. Because Mitch McConnell knows he can't get anything through this Senate without some Democratic support. Now, that reality of that midterm election has a lot to do with the agenda of the 114th Congress. The first thing the Republicans wanted to focus on was energy independence. We actually saw them pass a clean Keystone Pipeline bill. They were asking President Obama to simply give away Keystone Pipeline for nothing in exchange. Now, is there anyone here thinking that President Obama was likely to sign that bill? Yeah, even the Republicans knew he was never going to sign it. But that's not really the point. The point was they wanted to have that marker in the ground. They also want to talk about opening up more federal lands to drilling and fracking. As you know, we've had this explosion in petroleum development around the United States, and the lion's share of that has been on private land over the last 8 years. Republicans know that the United States federal government owns huge swaths of the western parts of our country, and they want to open up those federal lands to drilling and fracking as well. Now, that obviously will shoot up supply of oil, which we could argue we already have a fair amount of supply. But Republicans had an answer for that too. They wanted to open up exportation of crude petroleum products. They're still working on that as a change in policy for our country. And that would obviously alleviate that extra supply, allowing those products to flow onto the open market across the world. The Republicans also wanted to focus on immigration, if you remember. What they did is they simply failed or chose not to fund the Department of Homeland Security. They thought that would extort a win from President Obama. They thought that would force him to back away from that executive action on immigration he took in November of last year. And again, if you follow Andy or me, we told you back in December that that was an ill-fated political move. Politically speaking, that was never going to work. And obviously, the Republicans had to back away from that in early February and fund the Department of Homeland Security. Now, we're going to spend the majority of our time today talking about the Affordable Care Act and tax reform. Now, you may be thinking to yourself, why are we talking about the Affordable Care Act? And I'll get to that in a moment. But before I do, I always like to remind audiences of what was the original intent of the Affordable Care Act. The original intent, if you go all the way back to 2008 and 2009 in its early development, was to improve the health of our overall country. But somewhere along the way, and for whatever reason, we took a complete right-hand turn and we ended up with a health insurance reform law. Now, I've worked with the law for the last 5 years, and I've come to fully understand the law in a different way. And I think this is where you can engage your clients in a new and different way about talking about the Affordable Care Act. Because while, yes, it certainly revolutionizes and changes dramatically the health insurance industry, it has just as much impact as a retirement reform law. And let me explain what I mean. It starts with the way we pay for the Affordable Care Act, and this really goes to the psychological well-being and the confidence of our clients in retirement. Quick show of hands, how many of you would say a client's self-confidence and confidence in retirement is an important issue? Right? Every one of us, we understand that retirement psyche. And these two issues go directly to that sense of well-being. And I remember I said we pay for the Affordable Care Act in two ways. You remember that 3.8% tax on taxable investment income for families that earn more than $250,000 and Medicare cuts to doctors and hospitals. So let's start with that 3.8% tax. I imagine that you met with a lot of your clients in, say, April or September of last year after they met with their CPAs, and your clients may have been a little surprised at how their effective tax rates went up. Were they expressing some anxiety about that to you? Yeah, every client was that fell into this category. Ladies and gentlemen, the lion's share of that tax increase that impacted your client's effective tax rate was that 3.8% tax, leaving your clients to feel a little more put upon, maybe even a little less confident about the direction of taxation in the future and how that may impact them in their retirement years. Now, the second issue goes to a little bit different aspect of their confidence level. What that is lower Medicare reimbursement rates for doctors and hospitals. And let me play this out for you. If I'm a Medicare beneficiary and my doctor and hospital now get paid less to see me, I'm less profitable to them. So you tell me as business owners, do you think my doctor is more or less excited to see me walk in that front door? Maybe a little less likely, because I'm not as profitable. And ladies and gentlemen, that lower profitability on Medicare beneficiaries has led to some significant, in certain areas of our country, access to care issues. Now, if your clients have lived in the same neighborhood for the last 20, 30 years and they've been going to the same doctor, that's not an issue. But how many of your retired clients want to, for example, snowbird and have a second home somewhere else, and they still will need access to care? How many of your retired clients, their plan is that they're going to move to where the kids or grandkids live? They are finding in some of those areas some real access to care issues. If you want to scare a Medicare beneficiary, talk about access to care issues. That fear that they won't have the ability to get the care they know they're going to need in those retirement years, it is absolutely paralyzing for those individuals. And unfortunately, we'll experience that ourselves at some point in our own lives. But these two things, while tactical and tangible, being tax and cost cuts, are towards their psychological well-being. But let's get a little more tangible. Have any of you noticed that there's been a little bit of a trend in the healthcare industry of shifting costs from the insurance companies to you and I, the insured? Have any of you experienced your deductibles and co-insurance and out-of-pockets going up over the last several years? That's indicative of that cost shift to you and I, the insureds. And our retired clients aren't immune to that. HealthView Services came out with an incredible survey last year. And they found that if you retire today on an average Social Security income, you need to expect that literally 69% of that monthly check every single month will go to pay for out-of-pocket medical costs. Now that's deductibles, co-insurance, drugs, all of that stuff. But 69%. If you retire 10 years from now, that number goes to 82%. And if you're in my bucket, 20 years out, it's 127%. Now, I don't know about you, but that's a little scary. But I work with financial advisors every day, and I know what you're saying. You're saying, well, Jeff, you don't understand my clients. My clients are wealthy. My clients don't live on Social Security. But we've heard about this little thing in our industry, right, called the baby boom generation. And we know mathematically that 10,000 Americans are turning 65 today. You tell me, what percentage of those 10,000 Americans turning 65 today are showing up in retirement and their only source of income is Social Security? Probably a pretty fair chunk of those, right? And you don't think that's going to have a trickle-up effect on your wealthy clients? You're lying to yourself if you don't think so. As a matter of fact, it already has. You remember we passed that permanent doc fix bill back in May. You remember that? Well, how many of you recognize inside that permanent doc fix bill, there was additional means testing for Medicare beneficiaries? So your wealthy clients next year will be paying a higher premium for their Medicare coverage. You may not be aware of that, but that's indicative of this shift in cost to you and I, the insureds. But there's another dynamic shift that I want to make you aware of, and it's in the medical community. It's shifting from what we know as a fee-for-service world, which is what we've all known throughout our lives, to what's called outcome-based medicine. It's also called protocol-based medicine. The concept's rather simple. It simply says that if you go to your doctor and you have condition A, you get treatment X. Treatment X is protocol for condition A, and the insurance company pays for treatment X. But how many times do you go to your doctor and they say, Jeff, I know you really well, and you've got condition A, and I want to do treatment X. But because I know you so well, I think you will do even better if we add treatment Y. Does that sound familiar, or is it just my doctor gouging me? Yeah? Okay, so it's familiar. Well, you tell me, is treatment X is protocol, is treatment Y protocol? No. So who pays for treatment Y? The patient, the insured. But it's not an insured coverage. So think about this for a moment. Your clients, your retired clients, go into their trusted medical professional, and that trusted medical professional says, we're going to do treatment X, and the insurance company, Medicare, is going to pay for it. But you really need to add treatment Y, but you'll have to pay 100% of that cost. How many of your wealthy retired clients will immediately reach for their wallet, pull out their credit card, and pay for treatment Y? Meaning an additional cash flow issue for our clients in retirement. Now, I'm going to challenge your memory here for a moment. How many of you remember that when we passed the Affordable Care Act back in 2010, it had a guaranteed issue, guaranteed renewable long-term care benefit? Did you know that? Oh, it absolutely did. The Congress said, gathered the 200 of the best actuaries from around the country, and they stuck them in a hotel conference room like this for 6 months. And they said, we passed this great law. Now, you guys figure out actuarially how to make this long-term care thing work. They emerged out of that conference room 6 months later, and what do you think they had in hand? Nothing. They came out and said, you guys passed a lemon. There is no way we can actuarially make this long-term care program work. So we simply just forgot that that was a part of the Affordable Care Act law, leaving our country with no long-term care strategy. Oh, well, that's not really true, is it? We have a national long-term care strategy. It's called Medicaid. Now, how many of your clients are excited about signing up for Medicaid? Probably not very many. So leaving our clients who have assets, who have wealth, have options. It's imperative that we as financial advisors bring those options to our clients' knowledge. Now, I'm not saying they have to buy something. That's not the point. The point is we have an obligation to make sure they're aware of those potential risks in their retirement years. Now, I've been a little bit hard on the Affordable Care Act. Let's talk about something a little more fun. Let's talk about tax reform. How about that? How many of you know that there's a lot of bipartisan agreement on tax reform? Oh, there absolutely is, ladies and gentlemen. Both parties agree we need to clean up and simplify the tax code. That's what they agree on. Unfortunately, that phrase, clean up and simplify the tax code, means two completely different things to the parties. Republicans, when they hear clean up and simplify the tax code, they hear an opportunity to broaden the base, in other words, more people pay into the system, but lowering the marginal rates. If Republicans have their way, the rewriting of the tax code would not generate one new dollar in federal revenues. Now, the Republicans would quickly retort with the fact that, oh yeah, but Jeff, that cleaning up and simplified tax code will unleash untold economic growth. And that untold economic growth will generate a ton of new revenue. And they're fine with that. They just don't want the writing of the code to generate that first dollar. Now, Democrats, they take a little bit different tack when we talk about tax reform. They want to clean up and simplify the tax code in an effort to make it more fair. Fair is a bit of a code word when we hear from Democrats as it relates to tax reform. What they're really referring to is the slope of the progressivity of the U.S. tax code. Now, I know that's a little bit wonky, and it's really simple. It just means what percentage of the overall federal tax take falls on what percentage of our population. The Joint Committee on Taxation just updated their numbers for last year, and they found that for those people in our country and in this room that are lucky enough to be in the top 1% of wage earners in the United States, thank you very much. You're paying 49% of all federal tax revenues. Now, I know this is a learned audience, and you're saying, well, yeah, Jeff, come on. You're using the baked numbers. If you included payroll taxes, that number would go way down. No, ladies and gentlemen, I could have used that number, but I chose to use the number that included payroll taxes. So this is all federal personal tax revenues, 1%, 49%. Half of all federal tax revenues paid by 1% of our population. And I'm sure all of us are fortunate enough to be in the top 10% of wage earners in our country. We're paying 82% of that federal tax burden. So that is what the slope of the progressivity of the code is today. And I'm not commenting this too steep, too shallow. We'll talk about that as it relates to tax reform when we get into that debate. But it was based on that tax increase we had back in 2013. Now, ladies and gentlemen, interestingly, this was the negotiated settlements between the Republicans and Democrats to avoid the fiscal cliff. Ladies and gentlemen, this tax increase is the single largest tax increase in dollar terms in U.S. history. And we're not going to pay attention to the numbers. I want you to pay attention to the color coding. I tried to color code it so it gave you a good visual as to the real impact of this tax change. It obviously increased the complexity of the tax code, but the more you earn, the larger share of that federal tax burden you're shouldering. In other words, it increased the slope and progressivity of the U.S. tax code. Now, we're investment professionals, so we're more focused on ordinary and capital gains rates. This tax increase represented a 30% increase in ordinary rates and a 67% increase in capital gains. So hopefully, if I'm your client, it's making you send up a little red flag in your back of your mind. Hopefully that little red flag goes up and you go, wow, if my client's experiencing this investment tax growth, I may need to be thinking a little bit differently not about asset allocation, because nothing changed in my client's life, but I darn well better be thinking differently about solution allocation. In other words, where am I asset allocating so I manage and minimize my exposure to these increased tax rates? Now, this is where the tax rate code is today. And I promised we'd talk about tax reform. I want to see a real quick show of hands. How many of you would say you have a high degree of confidence that we are going to get tax reform done this year? That's exactly my point. Not one of us. But that doesn't mean that we don't need to understand where the battlefield lies. In order to understand where the battlefield lies, you have to understand where the two parties officially stand on their tax positions. President Obama was very prescriptive in his 2016 budget offering. He suggested that we need to double down on that capital gains increase and raise it to 28%. Ladies and gentlemen, that would represent an 87% increase in capital gains rates in the last 3 years, should that have gone into play. In addition to that, he would cap all itemized deductions at 28%. Here's the most important part: cap all itemized deductions at 28%, regardless of how high marginal rates go. You see, not a lot of Democrats are married to this 39.6% rate. A lot of Democrats still see a lot of upside, or some upside, to that marginal rate, certainly on the wealthiest 1% and 2% of our population. He would also suggest that we need to add required minimum distributions to Roth IRAs. He would cap new contributions to qualified plans once our plans reach a certain value. Probably the biggest impact that President Obama put out there was around death taxes. We know President Obama, and he has in the past, said we need to go back to the 2009 estate tax code rates of a $3.5 million exemption with a 45% rate. But on top of that estate tax, he would also eliminate the stepped-up basis. We know right now if we put our client in a position at $2 and it grows to $20 and they pass away, nobody pays capital gains on that $18 growth. That's stepping up the basis in that stock. Well, President Obama says that that's a trust fund loophole that he mentioned in his State of the Union address. So he would suggest that not only do your clients need to pay estate taxes on that asset, but they also need to pay capital gains on the growth of those positions. Ladies and gentlemen, this would represent a huge increase in death taxes for our wealthiest clients. So that is where the Democrats' stand is today. That's their official position. So that's that side of the battlefield. Let's kind of move over here and talk about the Republican position. Their last public position on personal tax rates is they promised us two marginal tax brackets, 10 and 25%. And they accomplished that in their plan. Oh, unless you earn more than $450,000, then there's a 10% surcharge on top of that 25% rate. Now, we're all friends here. They promised us two rates, but let's be honest, they gave us three, right? 10, 25, and 35%. We're not going to throw them out of the window for that. The real question is, well, hold on a second. If you're lowering marginal rates, somewhere, somehow, we need to generate some additional revenue. And where they chose to gain that additional revenue is through the elimination or minimization of some pretty significant tax deductions. For example, to the extent that you offset the health insurance premium cost for some of your employees, right now they receive that as a tax-free benefit, right? Being an employee of yours. Well, now if the Republicans have their way, that offset, that premium offset that you're paying for that portion of their health insurance premium would be added to their taxable income. In addition to that, how many of you are aware that the Republicans were the ones that put municipal bonds being partially taxable on the table? Did you know that? Now, I understand you're from all over the country, and I imagine a lot of you are from, say, New York, New Jersey, Massachusetts, Connecticut, California, Washington, Oregon, Illinois. Hopefully, some of you are in tune enough with tax policy that you saw a common theme amongst all those states. They all tend to be high state and local tax environments. Well, guess what? If the Republicans had their way, that state and local taxes that you paid on an annual basis would no longer be tax deductible. Now, if you're from one of those states, you probably just had a big gulp because you went, oh my gosh, that is a huge tax increase for me and my friends and my clients in those geographies. Now, in addition to that, the challenge that both parties are having are very simple. So that's the defined battlefield, if you will, around tax reform. Here's why nothing's happening on tax reform. There's one reality that both parties have to reconcile. They have to reconcile the fact that average effective tax rates are still historically low. Let me say that again. Average effective tax rates that we're paying in the United States are still historically low. Well, Republicans don't want to recognize that reality because they're saying it should be revenue neutral, not a revenue raise. Democrats are fine with raising the revenue, but ladies and gentlemen, if you want to bring the average effective tax rate to back up to even average, it's an unprecedented amount of tax increase. Now, I'm sure someone in this room caught that data only goes through 2011. And I just told you 5 minutes ago that we had the single largest tax increase in dollar terms in U.S. history just 2 years ago. So surely that big tax increase will have a dramatic effect on that average effective tax rate. Ladies and gentlemen, what that biggest tax increase in dollar terms in U.S. history did is take that 17.6% number to 19.2%. And still well under long-term average effective tax rates. That's the real challenge around personal tax reform. No one wants to admit it, but our revenues are at historically low levels. While I think you would agree, we're entering into a historically high period of cost in our country. Now, most of us probably aren't CPAs, but we know if our revenues are low and our costs are high, that's not a good thing, is it? And that's the challenge within personal tax reform. Now, there is more agreement on corporate tax reform, so I want to spend a little time there. We were actually quite hopeful that we were going to get corporate tax reform done yet this year. Both parties agreed that the marginal rates need to be lowered. Right now, our corporate marginal rates are the highest in the OECD countries. Democrats would lower it to 28%, Republicans 25%. So in the world of politics, if we're that close, we check that box. We say that's agreement. We can figure out that little difference between the two. As a matter of fact, interestingly, they even agree on how to pay for those lower marginal rates. They would both tax those unrepatriated earnings that are sitting offshore. We've all heard about these trillions of dollars of corporate earnings sitting offshore, not ever being taxed in the United States. Both parties say that that's how we would pay down those marginal rates. Now, a little sidebar here for a moment. I know that all of us are independent business people. I imagine a lot of us own our own business as a pass-through entity, an LLC or an S-Corp. Now, I know none of us do this in this room. Certainly, if there's anyone from the IRS in the room, we would never admit it. But I imagine some people that we know of who own pass-through entities pay themselves a very low W-2 wage through the year. At the end of the year, they pay themselves a big partnership distribution. Does that sound familiar with some of your clients? Now, why do they do that, ladies and gentlemen? Payroll taxes. Because we only pay payroll taxes on that lower W-2 wage. And so by being the owner-employee, I can manipulate my W-2 income and avoid taxation on those earnings. Keep in mind, we're talking about the employee and employer version of the payroll taxes, so it's not an insignificant number. Well, both parties agree that that's nothing more than a tax dodge. Both parties agree that that is a tax dodge that needs to be closed. Democrats would say that 100% of the earnings going through my LLC should be subject to those payroll tax limits. Republicans say 70%. Again, if we're that close and both parties agree it's a tax dodge, then we check that box. That's agreement on that payroll tax issue. The real challenge, and I talked about the challenge on personal tax reform, but the challenge on corporate tax reform is in the end game. What direction do we want to go as a country as it relates to corporate taxation? Democrats want to move to what's called worldwide tax system. Republicans want to move to a territorial tax system. Ladies and gentlemen, you cannot get more diametrically opposed than those two situations. Now, that being the case, I'm willing to spend about 2 minutes and talk about the difference between those two programs. Is that valuable to you? Yes? Okay. Worldwide tax system, the direction the Democrats want to go, would simply say to Apple, hey, Apple, good for you for selling that iPhone in Australia. I know you made a little profit on that sale. Good for you. Do whatever you want with that profit. We don't care. But because you're a U.S. domiciled corporation and you made that profit in 2015, you owe U.S. taxes today, regardless of whether you bring that money home or not. That's a worldwide tax system. Now, contrast that with the direction the Republicans want to go. They want to go to a territorial tax system. And that would tell Apple, good for you. Apple, good for you for selling that iPhone in Australia. I know you made a little profit on that sale. Do whatever you want with that profit. We don't care. But because you earned that profit in Australia, you will never pay a U.S. tax on that profit. Now, let's contrast these a little bit. Quick show of hands. How many of you would agree that Apple, being a U.S. domiciled corporation, has benefited from the infrastructure of the United States? And I'm not talking just about roads and bridges. I'm talking about education infrastructure and, more importantly, legal infrastructure of our country. Would you all agree that they probably have benefited? So maybe they do have some element of obligation back to the United States. So that's kind of an issue for the Republicans. But let's talk about the Democrat worldwide tax system. If I'm telling Apple that I don't care where you earn a profit, in the year you earn that profit, you're going to pay U.S. taxes because you're a U.S. domiciled corporation, what are we telling Apple computers to do? Move their headquarters offshore, right? My God, we can all agree we've done a lot of things in the tax code over the last 40 years to move jobs, move production, move even intellectual property offshore. Does anybody think it's a good idea we incent corporations to move their headquarters offshore? No, probably not. So you can see there's still an issue here within corporate tax reform. As a matter of fact, disappointingly, right before the Memorial Day holiday, Representative Ryan came out with a statement saying we're now looking for a down payment on tax reform, corporate tax reform. Well, let me define for you what down payment actually means. Down payment means is we're not really going to do anything except for what we absolutely have to do. What we absolutely have to do is deal with this whole tax extender issue because we're doing that on an annual basis, and that's silly. Let's extend them on a permanent basis, but then also deal with this whole inversion issue. You know, we're talking about the whole Burger King, Tom Horton, type of scenario where they're moving their headquarters falsely offshore for tax purposes. So we need to deal with that as well. The one that did concern me is this ambiguous third bullet point. This ambiguous third bullet point around tweaks around the code. Anytime you hear ambiguous language around tax changes, get scared because God knows what that means to them. And we're still trying to figure out exactly what that might mean, but I'll get into that here in a moment. The reality is we have to deal with one real issue in our country. We have to deal with the fact that our debt continues to grow as a percentage of our GDP. Now, you think about that in your personal lives. Can you keep adding debt as a percentage of your income without there being a day of reckoning at some point in the future? Absolutely not. And that's exactly what the Congressional Budget Office is telling us every single year when they send this data out. Now, President Obama has been running around the country talking a lot about the deficits come down precipitously under his tenure. And it absolutely has. That's the difference between the green and blue line. Without a doubt, the deficit has come down dramatically because it was falsely high because of 2008 during his tenure. But does not change the long-term trajectory of these numbers. You see, these numbers, these deficit numbers, these lower deficits that we're enjoying today, that's going to change about 2018. 2018, they're going to start to separate again. And I know what you're saying. You're saying, but Jeff, it's only this much. What's the big deal? Ladies and gentlemen, that much represents hundreds and hundreds of billions of dollars in new annual federal debt. So if that's true, that it doesn't change that long-term trajectory, then we need to understand what's driving that change. And it boils down to the cost of health in our country, and entitlements being a proxy for cost of health. Right now, the entitlement programs cost us about 60% of our federal budget. That's Medicare, Medicaid, and Social Security. The challenge with that, though, is that it's growing at 7.2% a year. Now, we know the rule of 72. That's not my point. This 7.2% growth rate is directly comparable to long-term GDP. Is there anyone here that thinks long-term GDP is going to average 7.2% over the next 10 years? Anyone? That's the problem. Our expenses, our mandatory spending is growing much faster than our ability of our economy to grow to cover that expanded cost. But that also goes to our debt service. We've been very fortunate that our interest rates have been very low from a federal debt perspective, but we're already expecting that the cost of our federal debt by 2019 will double, and it will triple within the 10-year window. So again, putting tremendous amount of pressure on the two red sections of our federal budget, the only part of our budget that Congress actually debates and allocates. Ladies and gentlemen, when you hear Congress say, oh, we approved a budget, or we didn't approve a budget, or we allocated a budget, or we didn't allocate a budget, they're only talking about those two red sections. The two green sections are mandatory. If you want to make changes to entitlements, you have to change the laws. And if we can't get a corporate tax reform done when there's 95% agreement, I think we can all agree that entitlement reform is probably even a little less likely. Would you agree? So that's the challenge we have as a country. Bottom line, we need to answer one very simple question in our country. We need to be able to answer whether the federal debt is a real concern or not. Now, believe it or not, 20% of the Democrats absolutely believe the debt and deficit is all smoke and mirrors. It's all a made-up issue by the Republicans. But at least that many Republicans think it's the only issue and be damned anything else. So that leaves us with about 60% of our elected officials who agree we have a problem. They just have a fundamental disagreement in how and how quickly it needs to be addressed. And ladies and gentlemen, you can boil down any issue our country is facing down to that simple equation. How and how quickly do we address our debt and deficit issue? Now, that being the case, we actually have something a little more tactical for you. Republicans seem to be setting up this perfect storm of events in September of this year. Now, I've trademarked this next term, so if you want to use it, you have to pay me a royalty. The Republicans are setting up what I'm calling Fiscal Mageddon 2015. Now, what Fiscal Mageddon 2015 is really nothing more than the aggregation of all these fiscal issues that we normally deal with throughout the year, all being focused into 1 month. We're talking about the debt ceiling issue. We're talking about the annual budget for 2016. We're talking about the tax extenders. We're talking about corporate changes that we talked about earlier. All of those things appear to be heading to culminate in this Fiscal Mageddon in September of this year. Now, you may be asking, well, why would the Republicans want to do that? The Republicans feel they've lost the momentum as it relates to monetary discussions in our country. The Republicans feel the Democrats have captured that issue of income and wealth inequality. We know they're going to run on that in 2016. Republicans want to run on fiscal responsibility. They think that's the good balance between income inequality and wealth inequality. So they want a culminating event to launch that into 2016. And that's what we anticipate this September of super fun for all of us. Now, does anybody remember the last time the Republicans set up one of these Armageddon scenarios? Anyone? It was the fiscal cliff deal back in 2012. That fiscal cliff deal in 2012 got settled. Do you remember the negotiated settlement between the Republicans and Democrats to avoid that fiscal cliff? Do you remember what that was? We went through it. It was the single largest tax increase in dollar terms in U.S. history. So it sets up this September where we anticipate a lot of market volatility, so that, that's a tactical play, and that's your business, not mine. But it also sets up this environment where we do believe new revenues will be on the table. New revenues are being discussed as we speak right now. I've aggregated a list here of what is being discussed today, but ladies and gentlemen, this is an extremely fluid list. This list literally changes from day to day to week to week. So don't hold me to this list, but I'm just sharing with you the kinds of things that are being actively discussed as ways of dealing with this fiscal Mageddon 2015. For example, the elimination of oil and gas pass-through tax treatment, adding those Roth RMDs, in addition to that payroll tax issue for us LLC and S-Corp owners, that payroll tax that we talked about, that's an issue that's being discussed, as well as some of these advanced wealth transfer techniques that we've all somewhat taken for granted that we've had for a long number of years, like GRATs and so forth. But bottom line is, this is a real challenge for our country. We have to deal with this fiscal issue, but it doesn't negate the fact that we also have to have longer-term planning discussions with our clients. Obviously, hopefully you heard it in my voice. I really feel as though, or believe though, that if you are having clients retire and you're not having a proactive discussion around that long-term care liability that they unfortunately will likely face during their retirement years, I think you're committing malpractice. And as I said earlier, I'm not saying people should buy something, but every client deserves to have an engagement, a discussion, an understanding about that potential liability. And that's also true of health care. It's now projected that every single one of us, when we hit our retirement years, will have $10,000 to $12,000 a year of out-of-pocket medical costs. So think about it. If you have a newly retired couple, in essence, they have a $20,000 to $24,000 a year fixed mortgage for the rest of their lives in retirement. If you had a client come to you and they said, we want to retire, we've got this $24,000 a year mortgage, the first thing that would pop in your mind is, you know what, maybe we should allocate some assets to manage that fixed exposure. Maybe we take some assets and move them over here to spin off enough income to make sure they know they have confidence that they can meet that obligation in their retirement years. It's a fixed obligation, treat it as such, is all I'm saying. And then finally, I call your attention to tax drag. You know, we talked to clients about tax drag back in the 90s all the time. It was always talking to clients about the after-tax return on their portfolios because tax rates were so high. But ladies and gentlemen, let's be honest, you and I have been lazy for the last 15 years because tax rates have been so low. Hopefully, I made it very clear what's changed is the progressivity of the code. So for your wealthiest clients, their tax rates have gone up precipitously, which means you need to engage them in that same way we used to. We need to be thinking proactively about tax-free, tax-deferred, tax-managed, tax-efficient. All of those advanced tax strategy platforms around solution allocation will become increasingly valuable for our highest income, highest wealth clients. So we need to make sure we factor that in. The real value of the financial advisor in the future, and I think this is my humble opinion, but it builds off what we heard in our panel that you had before me, is the real value of a financial advisor is marrying asset allocation, which let's be honest, we can go online and get asset allocation, but it's how we marry asset allocation with the right solution allocation based on that client's unique tax lens. Because if you're treating me as an LLC owner the same way as someone making the same annual earnings that's a W-2 employee, you're committing malpractice. We have completely different profiles. So you should not be solution allocating the two of us the same way. That, ladies and gentlemen, will never be able to be replaced by a computer. So I think that's the value moving forward. So with that, let me take a break. I've talked at you for some time, but I really am interested in your questions, and our clock up here is not working, folks. How much time do I have? Anyone? 10 minutes? Perfect. Good timing. So questions, please. Yes, sir. That's not a question. The comment was, you're not really a motivational speaker. No, I'm a truth teller. I'm a truth teller, and by God, we need to get these things under control. All we can affect is our world, our little world. You're my little world, but you have tremendous worlds that you operate in. You can impact change there. You can prepare your clients for those opportunities. And that's all so hopefully that is an answer to a non-question. Anything else? Yes, sir.
See a lot of conversions from S Corp pass-throughs to C Corps if they did lower that for individual businesses.
Yeah, well, I'll answer it this way, and if I don't get to your exact point, let me know. The reality is the perverted tax system we have today drives corporate entity decisions. That should never be the purpose of the tax code. So in a tax reform process, it should become irrelevant whether someone goes back and forth, C Corp, S Corp, and so forth. Obviously, we've seen an explosion of pass-through entities, throughout the last 10, 12 years. Right now, we don't see a huge shift back to C Corp, but if we don't get a handle on this differential between personal tax rates and corporate tax rates, we could see that trend back towards the C Corp. Right now, one other issue around corporate tax reform is, okay, if we lower Boeing's, for example, Boeing's corporate tax rate to 25%, is that fair to little old Jeff Bush? Jeff Bush is out here paying 39.6. Then I'm a little more motivated to go back to a C Corp, aren't I? So they have to reconcile that differential. And that was one of the other stumbling blocks to getting corporate tax reform done. Did that get to what you were asking? Okay, great. Anyone else? Yes, sir.
Can you think of any reason why the Republicans wouldn't be calling Obamacare never-check care with the election coming up?
The question was, is there any reason the Republicans politically wouldn't call the Affordable Care Act, also known as Obamacare, why not call it Democrat Care in order to tag that on to Democrats? Absolutely not. There's no reason why they shouldn't do that. It was passed with 100% Democrat support and 0 Republican support. So yeah, I think that's a fair attack on it. But you got to be careful what you're attacking. The reality is the Affordable Care Act, while generally unpopular, there's no doubt that the number of uninsureds has gone down. So it is having an effect. My problem with the Affordable Care Act, and you can see I'm not a huge fan of the law. My problem with the Affordable Care Act was it is the quintessential Frankensteinian legislation process. They literally took all these dead pieces, stitched them together, and in the middle of the night they zapped it and hoped it would come to life. And it did. And it was upheld in life just here in June. So while we have this Frankensteinian legislation that even the Democrats would say is not a good law, it is what it is right now. And as long as the Republicans are not engaging in a reform process trying to make it more effective, it will continue to be a Frankensteinian law. My problem with the Republicans is you can call the Affordable Care Act anything you want, but then have a plan. They have no plan. You know, they're talking about cross state lines and things like that. That's fringe issues. You got to get to the core issue that, you know, we have 330-some million people in our country, and I would like to think that the United States has risen to a point in our history that no American should go bankrupt because of a health issue, and every American should have access to care. Now, how we do that, that's where I think the debate lies. And my problem another problem with the Affordable Care Act, everybody agrees it's going to cost about $1 trillion during its first 10 years. Don't you think we could have figured out a better way to spend $1 trillion getting better access to care across our country? Probably so. Probably. Oh, great, thank you. Yeah, that's actually a slide I hid because I knew I was going to run out of time. The Cadillac tax is the question about how's that going to impact it. Originally, the Cadillac tax, as you know, it's a 40% excise tax for people who have really rich health care benefits. Well, I don't know about you, but who has really health care benefits? Is it you or I, or is it unions and so forth? It's a lot of unions. It's a lot of negotiated benefits, a lot of old blue chip type of corporations and things like that. The 40% excise tax, as it was originally designed, was thought it was going to only impact about 10% of employer plans. It's now anticipated that it may impact as many as 30% of employer plans. That's why you're seeing this huge shift, very quick shift, towards large deductible, high out-of-pockets, and everything else to get an option that will keep them out of that 40% excise tax area. Yeah. Yes, sir.
How likely is that change on the taxation of MLPs?
You know, right now it's certainly on the table. I think it's as likely as any of those things I've listed up there. It's been discussed in several venues. And it's interesting, when you start looking at tactical tax changes from an analyst perspective, I call it a fishing expedition. The more times, the more lines you're seeing dropped. In other words, the more times you're hearing that MLP issue in different contexts around Washington, that's when you start getting concerned. Because you're starting to get a collective thought that that's something that needs to be addressed. So I would tell you I'm getting a little more, thinking that that's more likely. If we see some tax changes, is certainly one of those things on the board. Now, keep in mind, what we also believe is that it will not impact previous MLP shares, okay? They would set an X date, and pre-X date, they would get that pass-through tax treatment. Post-X date, you would have some kind of new tax treatment, okay? So I think your clients will still be fine with the MLP shares they own. Yeah. Yes, sir.
I notice on all those screens you have elimination of the stretch IRA. What's the likelihood of that one?
Again, I think that's, again, in that same vein. The reality is, the problem with Roth IRAs and stretch IRAs, the only people taking advantage of them are the people of wealth. And because that's the truth about those programs, that's why they're kind of in the crosshairs right now. It's a small group of people, although could be some sizable dollars, it's a small group of people. And it's one of those taxes that are perceived to be only benefiting the wealthy. That's why you hear mortgage interest rate deduction brought up a lot as well. If you have a $50,000 house versus a $1 million house, it's disproportionate the gains go to that individual. Yeah. So, yes, sir.
HR 25, the fair tax, do you see us going to
Significant tax reform for HR 25?
Yeah,
Fair tax?
you're going to hear fair tax, flat tax, consumption tax, all of those things are definitely, you're going to hear a ton about them throughout 2016 race. The reality is this: if you really talk to people who understand tax law, tax behavior, and everything else, be very careful with a flat tax. Because a flat tax is a victim of its own rhetoric. And what I mean by that is a flat tax is also called a fair tax, right? It's fair. But you know what? If they say that a fair tax is 15%, and the next Congress comes in and says, no, those guys were idiots. The fair tax should be 18%. It's equally fair at 18% as it was at 15%. And you end up this incrementalism, calling it fair all along. So generally speaking, I'm not a big fair tax fan. Personally, I would love it. I'm just saying realistically, across our country, I don't think that's a solid direction. I would like to see us go in a more consumption tax direction, but that's a regressive tax on lower income individuals who spend 100% of what they earn. I don't. I'm fortunate enough I get to save the majority of what I earn. So there's a disconnect there. Does that answer your question, Dizzo? Right, yeah. I think there is some possibility of a national consumption tax. We've had a sales tax in the past. That was, after World War II to pay down the federal debt. So it's certainly a possibility. And I've run out of time. You can connect with me. You saw that slide up there with all the different ways to connect to us. But thank you very much. I appreciate your time today. Have a great rest of your meeting.